Welcome to the Deep Dive, where your shortcut to getting smart fast. We dig through the sources, pull out the key stuff, and walk you through it. Today, we're jumping into the future of crypto. Specifically, we're looking at how regulation, infrastructure, and innovation all fit together, or maybe how they have to fit together. Our source material. It's from a really interesting segment on Nasdaq TradeTalks. Jill Malandrino hosted, and she had two key people from Metallicus, Marshall Hayner, the CEO, and Peter Cuderman, their VP of Government Affairs. So our mission here is to unpack how all these legislative moves, the infrastructure being built and the innovation that's happening, how it's all shaping what's next for digital assets and for Web3 finance. We want to get into the what's, but also the why it matters for you. It's moving fast. Okay, let's unpack this.
Yeah, and what's really fascinating, I think, is how these things that seem separate, like lawmakers doing their thing over here and tech people building stuff over there, are actually deeply connected. They're really converging, And that's defining where crypto goes next. It's not just one piece. It's how they intertwine.
Yeah, that connection, that codependence, it really jumps out from what the Metallicus guys were saying. Peter Cuderman mentioned something called the Genius Act. He framed it as, pretty pivotal. Can you help us understand what exactly that is? And why is it such a big deal, especially when we talk about stablecoins?
Absolutely. So the Genius Act, and it's an acronym, stands for Guidance for Establishing Netting Interoperability, Ubiquity, and Stability Act. It's basically proposed U.S. legislation. Its whole aim is to create a clear rule book for stablecoins, which is huge because right now, or up till now, many have been operating in this kind of regulatory gray zone. This act wants to define them, set rules for who can issue them, how they should be backed, essentially provide clarity. Moving from, ambiguity to a proper, legitimate framework.
Okay, so providing legitimacy, a clear pathway, that sounds crucial. But isn't there always that concern that regulation might, initially stifle innovation, slow things down? How do Peter and Marshall square that circle? They seem pretty convinced that regulatory readiness is actually a competitive advantage, not a drag.
Yeah, that's a really good point, and it's sort of where their perspective flips the script a bit. They argue that clarity, having that secure, compliant environment, actually boosts innovation because companies can then build with confidence. They know the rules of the game. Think about if you build for compliance from day one, you're potentially more attractive to institutional money, right? Yeah. You can partner more easily with traditional banks. You build consumer trust faster. So it gives compliant players a head start, maybe, enabling innovation within a trusted system, not just out in the Wild West.
That's a strong argument. Building trust, building stability as the foundation for real adoption. And it's not just talk, right? It's actually shaping the tech they're building. Which brings us to Marshall Hayner talking about infrastructure. He kept emphasizing the metal blockchain as a layer zero protocol. What does that mean? Layer zero. And why is that specific structure important for achieving this vision of compliance and real world use?
Right. So think of blockchain layers. Layer 1 is like Bitcoin or Ethereum. Layer 2 solutions sit on top of those. Layer 0 is even more fundamental. It's like the bedrock, the foundational plumbing, maybe. It's the layer that allows different Layer 1 blockchains to potentially connect and talk to each other. Interoperability is key here. For Metal blockchain, being Layer 0 it's designed from the ground up with this interoperability in mind, but also to support these compliant, sometimes permissioned environments. This is really important if you want, say, a stablecoin issued on one bank's private chain to be usable somewhere else. Or for traditional finance to connect safely to the public blockchain world without breaking all their existing compliance rules.
Okay. So it's not just building another blockchain, it's building the right kind of foundation. One that can bridge the old financial world and the new decentralized one, safely, easily, and compliantly. That leads right into their point about permissioned environments. Why are these controlled spaces so critical for banks, fintechs, regulators? What do they unlock?
They're vital, really. For regulated institutions, compliance isn't optional, it's everything. Permissioned environments mean you control who participates. You can build in things like KYC, know it. Your customer and AML, anti-money laundering, checks right into the network's rules. This gives you a level of trust, accountability, and security that you just don't get in fully open, permissionless networks, at least not easily. And regulators need that. This focus allows for new kinds of services. Think tokenizing real-world assets like bonds or real estate, or creating private payment systems, stuff that's really hard to do on public chains today because of those regulatory hurdles.
It really sounds like this kind of robust, compliant infrastructure is the key piece, the thing needed to move blockchain from just speculation, which we've seen a lot of, to actual widespread use. utility. And once you have that infrastructure, what are the tools that emerge? Marshall and Peter highlighted stablecoins and digital dollars. They see them as crucial for the next step in payments and banking. What's the difference between the two, and why are they both considered so pivotal?
Yeah, good question. It's a key distinction. Stablecoins, like we touched on, are crypto assets designed to hold a steady value, usually pegged one-to-one with a fiat currency, like the US dollar. They're typically backed by reserves, cash, bonds, etc. Think Tether, USDC. They offer blockchain efficiency with traditional currency stability, or that's the goal.
Right.
Digital dollars, though, usually refers to a potential central bank digital currency, a CBDC. That would be issued by the government, by the Fed in the US case. It's essentially the government's own digital version of its currency. Both are seen as pivotal because they act as that stable bridge. You need something reliable for value transfer on-chain, whether it's for instant payments across borders or DeFi lending or even, payments that trigger automatically based on code.
It really does underscore how getting the regulation right and building the right kind of infrastructure, how that's what unlocks the really significant innovation here. We're potentially moving beyond just, trading coins toward integrating this tech into everyday finance. So, okay, wrapping this up, what does this all mean for you listening in?
Well, it seems if you're tracking this space, the takeaway is to really watch the projects and the policies pushing for regulatory clarity and building that compliant infrastructure. They seem likely to lead the next wave, especially with institutional adoption and real-world applications. And for innovators, the message seems to be, don't see compliance as a burden. Maybe see it as the necessary foundation to build something truly scalable, secure, and impactful.
Yeah, and if you connect all these dots, it raises a pretty fundamental question, I think. As this technology matures, is it possible that true widespread innovation and adoption, can it only happen when it's built on that solid ground, that foundation of regulatory certainty and strong compliant infrastructure? Is that what's needed to really blur the lines finally between traditional finance and this decentralized future?
That's definitely something to think about. How does that convergence reshape payments, banking, digital assets for all of us?
Lots to consider. Thank you for joining us on this deep dive.